Something unusual is happening in the markets, according to BCA Research. There's a 65-day correlation of bonds, commodities and equities, which has happened only 3 times since 2000. Dhaval Joshi, Chief European Strategist at BCA Research, joined us now with some more of what's going on. Interesting research you've come up with. Explain more about the fundamentals, what's going on here.
Well, the first thing is it's very, very unusual to see all asset classes moving together to this extent, and as you say, it's only happened 3 times this century. On each occasion, it's been to do with some major change or perceived change in central bank policy. So it happened in 2013 during what's known as the US taper tantrum, when they were talking about backing away from QE. It then happened a couple of years later when the ECB started QE, and it's happened now. So these are 3 very specific incidences in the 21st century. As you can see, they didn't last. So the question is it going to last? I would say probably not. I mean, you will see this. You will see all these assets moving together for some, for a little while, and then I think one of them is going to break down. The question is which one. But in all instances, it's about central banks driving all markets. And the question is, how long can that be sustained? I would argue that on the way down, as is happening now and happened during the taper tantrum, it's self-limiting, because as bond yields go up, that sort of hits the economy. As equity prices drop, central banks don't like it too much if it happens violently. And then they sort of back off. So that's one way this could end. That there's a sort of feedback mechanism into central bank behaviour.
I believe your research also uncovers the fact that before 2000, this was quite a regular event, wasn't it? More regular than it is now in the last 16 years. Why?
So essentially, between 1980 and 2000, so a sort of 20-year period, we had a correlated re-rating of all assets. In other words, all assets went up. Or, the tide lifted all boats, which is on the way up is everyone likes that because prices are going up. But it was fundamentally justified because bond yields and interest rates were sort of coming down as inflation got kicked out of the system, and this lasted structurally for 20 years. The question is this all going to reverse? Are we going to see a structural derating of all assets, which obviously would be very, very bad news because all prices go down in unison. But as I say, because of the feedback into the economy through lower financial asset prices and the impact of higher interest rates on behaviour, there might at this moment be a self-limiting aspect to it.
Meaning that central banks won't want to raise interest rates too fast because it's going to cripple what little growth we've got.
Exactly, because what happened between 1980 and 2000 was that interest rates came down structurally. I mean, not in a straight line, but they sort of trended lower. So that helped all asset classes to go up because yields on everything were falling, so prices go up. So the question is that going to happen in reverse? But for that to happen, obviously, interest rates have to trend significally higher. But I don't think that's I don't think that's possible. In fact, as we've seen in Japan, you try and do it, and then the vicious feedback in the economy and in the markets prevents you going up too far.
So what do you think we have learned from Japan? Because Japan doesn't seem to be cured. They've tried and failed. I think that's to be said. Much hope was pinned on Abenomics. Doesn't seem to have worked. And we've got the rest of the world now following Japan down. There is no solution.
Well, it means that when you have so much debt in the system, as most economies do, it's much more difficult to raise interest rates. Or put it another way, the impact of a small interest rate on the economy and on markets is amplified, which makes it very difficult to have a sustained sequence of tightening or even an unwinding of easy policy. And that's a problem that the central banks have to contend with. Now, I mean, Japan's had to contend with it for a long time. But now it's an issue for the ECB, it's an issue for the Fed, it's an issue for the developed world.
Yeah. So what's the trade then out of this? Bearing in mind you've got this uncertainty, we've been here before, we sort of have a feel as to possibly how to deal with it. What's the trade that you would suggest putting on?
Well, an interesting trade idea would be, it's based on the idea that you've got all these things moving together, but they're not going to move together forever. One of them is going to break down. We don't necessarily know which one it is, but so the way to play it is to perhaps buy call options, out of the money, deeply out of the money call options on all three. So by that I mean, let's say the equity market, let's say the Euro stocks, the bond market, let's say the 30-year US Treasury, and the commodity I'd go for is gold. So what I'm saying is that two of the options will expire worthless because the trend continues, and one of them will make a lot of money for you, offsetting the losses you make on the other two. Because if that breaks ranks, if you like, if that asset class breaks ranks, then the option will go deeply into the money, and it could multiply several times over.
Look, Dhaval, we've got to leave it there, but thanks indeed for joining us. Dhaval Joshi is the Chief European Strategist at BCA Research.